Welcome to ValueMulticaps. ValueMulticaps SEBI registered stock advisory firm. Nifty 50, the most important index benchmark, has again reached 11,000. But there is hardly any celebration among investors. Nifty 11,000 of October 2018 to Nifty 11,000 of February 2019 hardly have stock winners, but majority of stocks are net losers as per their participation in recovery of Nifty. As they say, devil lies in detail. Let's dig into the details of this Nifty recovery from 11,000 to 11,000. Nifty closed yesterday above 11,000 level. Nifty was at 11,000 level last 1st October of 2018. However, 30 Nifty stocks been below the levels of 1st October 2018. Market capital of BSE stocks has fallen. If you see, on 1st October, the market cap was 1,53,000 crore. While today, on 6th of Feb, it is 1,41,000 crore. So net it is down by 9%. Within Nifty, maximum large cap stocks generated negative return. As much as 30 stocks are down. But the contribution from few heavyweights like Reliance, Infosys, HDFC Bank, HUL, Kotak hitting lifetime high and restricted the sharp drawdown of the index. Within these few stocks gain, we would have been a bear market. Bear market is fall of the index by more than 20%. The broader markets underperform the benchmark index, with the Nifty Mid Cap 100 and Nifty Small Cap 100 is down by 3% since last October 2018 to now in February 2019. If you see the broader market participation and as well as the sector wise, Nifty Bank is up by 8%. But on the other hand, Nifty Metal is down by 20%, followed by Nifty Auto and Nifty Pharma, which is also down by 11%. Hence, the Nifty is not at all reflecting the reality of broader market. We are already in a bear market for many micro caps, small caps and mid cap stocks. Many of these stocks may not see those astronomical prices again till at least the next bull run begin. What factors led to this broader Indian equity market situation? We had a fantastic run up over the last few years. Especially 2017 was a spectacular year in terms of returns. However, as we entered 2018, valuations were stretched and markets probably were looking for a reason to correct. We got plenty of them, starting with reintroduction of long-term capital gain, followed by a series of auditor resignation, alleged fraud in companies like Vakrangi and Manpasand making headlines, dampening the sentiment. Then there was a stock classification by SEBI for mutual funds, wherein a lot of small and mid cap stocks held by the so-called large cap mutual fund have to be sold in order to comply with new regulation. Then there was PNB fraud, IRNFS issue, and now it's NBFC crisis. The ongoing correction has brought a lot of stock portfolio drawdown. However, the valuations are mouth-watering now. At best, they can be called reasonable. Factors such as political uncertainty, where it will be a majority government or coalition government, foreign and domestic inflows continuity on the verge of liquidity issues in NBFC space, domestic inflows, especially 8,000 crore monthly equity mutual fund SIP have been a critical support for the markets, given that FI outflow of $4 billion during the period, which has been absorbed and replaced by Indian investors. So where do we go from here? We believe that the next 2 to 3 months is a good time to gradually build up the equity portfolio that can reap rich dividends over the next 1 to 2 years. Over the last 1 year, small cap index crashed by 30%, while Nifty remained range bound. The big divergence in small cap segment won't continue for the next 2 to 3 years. Within 2020 itself, the outperformance of small cap segment is very much expected. Not all the small cap stocks that crashed will bounce back. Stocks those crashed for having corporate governance issue or a balance sheet issue may not bounce back even in few years. On the contrary, small caps, those remains fairly stable over the last 1 year, would bounce back fast. Historically, equity markets fared very well in the next 1 year after the general election. The primary reason is that after general election, every rational government shift from populist stand. We are expecting no such exception this time also. Also, History shows that over longer time frame, there hasn't been a strong correlation between market returns and any specific government. Over the last 30 years, average equity returns have been healthy irrespective of whether we had a clear majority or a coalition. You generally get such opportunities at very attractive valuation as nobody is interested in them. During such uncertain times, those sitting with idle capital may also hunt for opportunities in a reform-oriented sector by the government of the day, sectors with earning visibility and futuristic business model. We hope this equity market perspective will help your decision making in equity investment. Our website ValueMulticaps.com give you free research report and market newsletters with hot stocks on fund manager and analyst radar. We will love to see you in the comment section and in our email inbox as well. Thank you for watching this video. Let's sum up this video with one investment lesson.